Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AVISTA CORP quarterly report. AVISTA Corporation offers a diverse range of businesses and services, including electric distribution and transmission, natural gas distribution and transmission, electricity generation through hydroelectric, thermal, wind, and solar facilities, wholesale purchase and sale of electricity and natural gas, supply of electricity to customers in Montana, retail electric services to approximately 422,000 customers, retail natural gas services to approximately 383,000 customers, electrical energy supply to approximately 17,800 customers, venture fund investments, real estate investments, other investments. The company operates through two main segments: AVISTA Utilities and Alaska Electric Light and Power Company, AEL&P, serving various regions in the United States. AVISTA Corp stock price increase. A year in review over the past 12 months, AVISTA Corp's AVA stock has shown a modest increase of 3.97% as of early November 2025. While this growth is lower than initially expected, the company's stock price did reach a 52-week high of 11.4% above its current trading price at one point. A significant factor contributing to the positive sentiment and potential stock price increase is AVISTA Corp's strong third quarter 2025 financial results. The company reported a third quarter profit of $29 million, surpassing analyst estimates by 24 cents per share. Year-to-date net income also rose to $1.51 per diluted share, compared to $1.44 for the same period last year. These positive results were driven by strong operational execution, constructive regulatory outcomes, customer load growth, and disciplined cost management. AVISTA's affirmation of its 2025 consolidated earnings guidance further supports the company's financial health. These factors collectively contributed to a slight increase in AVISTA Corp's stock price over the past year, indicating a positive trend for the company's future performance. The primary drivers of revenue growth or decline can be summarized as follows: revenue growth drivers, general rate cases, which increase net income, increased investment gains from higher valued investments, rate-regulated sales of electricity and natural gas to customers, revenue decline drivers, increased operating costs, depreciation, and tax expenses, decreased generation at hydro facilities due to lower water levels, tariffs on imports, increasing capital and operating expenses, net income and profit margins. A shift in performance. The financial performance of a company has undergone significant changes over the past year. Net income has increased from $18 million to $29 million in the first 3 months of 2025, and further rose to $122 million by the end of the 9th month. This growth can be attributed to various factors, including decreased investment losses due to lower valuations of certain investments. However, profit margins have shown a mixed trend. The operating margin initially declined from 12.4% in 2024 to 14.9% in the first quarter of 2025, but later improved to 16.9% by the end of the 9th month. This fluctuation can be linked to increased operating costs, depreciation and amortization expense, and income tax expense. The impact of general rate cases on the company's performance is also a contributing factor to these changes. Despite the mixed results, the overall trend suggests an improvement in net income and profit margins over time. The company's financial performance indicates a positive trend in operating cash flow. Despite some discrepancies and potential errors, the majority of evidence suggests that the company has generated significant positive operating cash flow, with a notable figure of $394 million for the 9 months ended September 30, 2025. This confirms the company's ability to produce positive operating cash flow, which is a crucial indicator of financial health. The company's financial health has undergone a slight change. The debt level has increased from $2,614 million to $2,753 million, indicating a rise of $139 million in long-term debt. Similarly, total liabilities have also seen an increase from $5,350 million to $5,517 million. However, interest expenses show mixed results, with a net decrease of $2 million for the 3 months ended and an increase of $3 million for the 9 months ended. Performance overview. AVISTA Utilities stood out as a strong performer, with increased operating revenues and net income across both the 3-month and 9-month periods. AEL&P also showed resilience, reporting no net loss for the 9 months ended. On the other hand, several segments or regions struggled. Alaska's operating revenues declined, accompanied by an increase in net losses over both timeframes. The Colstrip segment faced challenges due to lawsuits and environmental issues, while Westmoreland Mine was impacted by permits and lawsuit-related problems. Additionally, a natural gas incident in Rathdrum, Idaho resulted in poor performance. Management is optimistic about the company's outlook, citing growing demand in the region as a key driver for increased resource needs. To meet this demand, the company has filed an electric IRP with regulatory bodies to identify additional generating capacity requirements. A request for proposal, RFP, has been issued to add energy and capacity, with a focus on optimizing current resources and capturing economic value through wholesale market transactions. The company expects to recover increased costs through various deferral and recovery mechanisms and is investing in capital expenditures to support growth. Avista Utilities' capital expenditures are expected to increase from $525 million in 2025 to $705 million by 2030, while AEL&P's expenditures will decrease from $19 million in 2025 to $14 million by 2027. Management also acknowledges the risks associated with extreme weather events and load growth in the Northwest region, but is taking steps to optimize current resources and consider new ones. The company will focus on greenhouse gas emissions compliance in Washington and Oregon and is working to recover increased costs through various mechanisms. Overall, management's strategy is centered around optimizing resources, investing in growth, and ensuring compliance with regulations. The company has a history of paying dividends to its shareholders. In fact, it has been consistently paying dividends over the past 2 years, with $119 million paid out in 2025 and $112 million in 2024. This demonstrates the company's commitment to returning value to its investors through dividend payments. Concerns about inventory buildup and supply chain disruption. The company's financial summary highlights concerns regarding inventory buildup and potential supply chain disruptions. Notably, inventory levels have increased by $35 million between December 31, 2024, and September 30, 2025, indicating a significant accumulation of stock. Furthermore, the emission allowances inventory has also seen a substantial increase from $79 million to $116 million. Moreover, the threat of tariffs on imports poses a risk to the company's supply chain. If implemented, these tariffs could lead to increased costs for critical equipment and materials, potentially disrupting the business's operations. These factors collectively suggest that the company may face challenges in managing its inventory and navigating potential supply chain disruptions. That concludes the financial summary for AVISTA CORP. Feel free to comment below, and I will be happy to answer them when possible.